Well, stocks starting the week with gains, looking to recover from last week's big sell-off. Now, tech has fallen about 7% in the past month alone, and you can see the losses, though, really steepen over the last week. You have the S&P 500 and the NASDAQ Composite both closing lower for 6 days in a row. So maybe today's upward momentum is going to snap that losing streak. But the NASDAQ shedding 2% on Friday alone, its biggest single day decline that we've seen in 6 months. So is this selling over? Is there more downside risk ahead? Here with more, we want to bring in Jay Pelosky. He's a TPW's advisory founder and chief investment officer. Jay, it's great to have you here. So talk to us just about the selling that we have seen in the Mag 7. Is there still reason, do you think, to own or buy into some of these larger cap tech names?
Yeah, I think, first of all, it's great to be with you. And look, these have been momentum stocks, right? It's been a momentum-driven market. And people were behind the curve, and so they had to race to catch up, which means they go into the momentum names. And they did a typical, market did a typical Wile E Coyote move and ran right over the cliff and right off the cliff. And so we had, I believe, 20 billion or so in CTA selling last week, just last week alone. And so we've gone from 3 weeks ago, we were talking about a bubble, right? And overbought in extended markets, particularly tech. And now all that's been washed out. So things move very fast. I think it's healthy. It's a feature of markets, not a bug, to have a pullback after a 27% move from October to March. So I actually think I looked this morning, NVIDIA, and I know that's not one of the ones you talked about earlier there, but NVIDIA is off 20% in the last month. And this is the poster child for AI. And to me, that's an opportunity because we're believers that we are in the early innings of the AI age, and semiconductors are the pick and shovel of the AI age. And so we have been exposed, we are exposed, and we continue to be exposed to the semi stocks in particular.
NVIDIA really needs to focus on moving up their earnings date. I think we in the news media finance would appreciate that. But Jay, I'm curious, as we wait for those NVIDIA earnings, what is going to be the thing that drives the tech rally moving forward throughout this month here, particularly given that we're starting things off with Tesla, and I could imagine that their earnings are not going to be very good?
Well, earnings are going to be the factor for sure. That's something we've talked about for some time with our clients. We've kind of traded off rate cuts, which are the thing that excited people in the fall and over the course of the winter, for earnings growth. And these companies, many of them are generating tremendous earnings, but we actually have a different take. We're more keen on tech outside the United States, and in particular in China. And so we have identified what we call a two tech stack divide between the US and China, where both countries are basically sealing off their tech sectors from each other. And we think that creates a real opportunity within China tech, which has been a huge laggard versus the US. Its e-commerce market is twice the size of the US, growing at 10% per annum, where in the stocks like Alibaba, Tencent, et cetera, are trading at a 50 to 60% discount to the United States tech stocks. So we look at Apple, which you were talking about earlier with the prior guest. Apple is the example of a US company and a US stock suffering because it is losing market share in China, which is its biggest market. And it's losing that market share because China is trying to drive its own homegrown tech companies and excluding the US, just like we're doing to them. And so we see tech in China as a real interesting way to play emerging markets, which have been a big laggard.
And Jay, we're seeing this call get more and more attention here. You mentioned Alibaba and you mentioned Tencent. When we're trying to identify that upside, that investment opportunity, what does the upside look like, do you think, in some of these names?
Oh, I think it's huge. I think it's one of the best risk-reward opportunities in the world. Because these stocks are selling at 8 times. Alibaba's at 7 to 8 times earnings. They're growing. They're going to dominate China and we think probably Southeast Asia, which is the fastest growing region of the world. And so the opportunity, we think, on the risk side, there's limited risk because Everyone who wants to be out of China has sold. They're trading at 8 times earnings. They're buying back stock. And the upside, the reward, we think is considerable. As an example, we focus mainly on ETFs here at TBW Advisory. KWEB, which is the China Tech ETF, could double from its current price around 26 bucks and then double again before getting to its March 2021 high, which was over $100. So you look at US Magnificent 7, close to all-time highs until the last week or two, and then you look at KWEB, which can double and double again before it gets to its 2021 high. And so we think that's really quite compelling.